In Chapter 3, we will begin looking at deductions for business expenses. The general rule is that business expenses are deductible as long as they meet the criteria of being ordinary and necessary, having a legitimate business purpose, and be reasonable. As you will see in this week's discussion topic, what the IRS has allowed as reasonable, ordinary, and necessary expenses can be very interesting. Business expenses can be deducted in several places on the tax returns, depending on the type of business and/or employee. This flowchart shows where the different types of expenses will eventually show up on the tax returns. In Chapter 3, we will focus on business expenses for self-employed individuals. These expenses will all be reported on Schedule C, which you will complete next week. The rest of Chapter 3 reads like a laundry list of allowable deductions and rules. The rest of this video will explain some of the key provisions highlighted in this chapter. The good news is that companies are allowed to deduct the cost of goods sold, and this calculation is identical to what you saw in financial accounting. The IRS allows taxpayers to choose the inventory costing method, FIFO, LIFO, or specific identification. Remember from Accounting 201 that we said LIFO generally results in lower income, and companies often choose this method in order to reduce taxes. In an effort to curb tax manipulation, the IRS requires that any companies using LIFO for tax purposes must also use LIFO for financial statement purposes. Chapter 3 does a great job of explaining which types of transportation expenses are deductible. There are two key points in this section. Number 1, normal commuting expenses are not deductible. Number 2, there is a difference between transportation and travel costs, even though both types of deductions are very similar in nature. Again, Chapter 3 does a good job of outlining deductible travel expenses. One of the key things to take notice of is the different treatment of travel expenses depending on the country of travel, especially if the trip includes any element of non-business or pleasure. This slide illustrates which travel expenses are deductible for domestic, that is U.S. only, travel that includes elements of both pleasure and business. This slide shows a very different allocation of deductible business expenses when traveling internationally for business. The stricter rules are intended to discourage self-employed individuals from taking expensive international vacations designed as business trips. Taxpayers may take a deduction for the use of a home office, but because of a history of fraud and abuse, claiming a home office deduction is often viewed as an audit red flag. If a space in the home meets all of the requirements for a home office, then all ordinary and necessary expenses associated with the office are deductible. The calculation of the home office can be complex because, in general, a home office deduction cannot create an overall loss for the business. To calculate the home office deduction, you take the business's net income before the home office deduction and first deduct mortgage, interest, and real estate taxes. Because interest and taxes are allowed as personal itemized deductions, this first subtotal is the only one that may be less than 0. If the first subtotal is above 0, then you subtract all other cash expenses such as utilities. This second subtotal may not generate a loss. If the second subtotal is still above 0, you can then deduct the portion of depreciation on the house that is attributed to the home office. Again, the third subtotal cannot be less than 0. In an effort to simplify this calculation, the IRS also allows a standard deduction of $5 per square foot for home offices up to 300 square feet. Chapter 3 discusses the treatment of net operating losses that can only be generated from business and/or casualty losses. The book tells us that a business can carry a net operating loss back 2 years or forward 20 years. This means that if your business had a net operating loss in 2015, it can apply that loss back 2 years to the 2013 tax year and get a tax refund. If there's any loss left over, the net operating loss can then be carried back 1 year to 2014. If there's any loss left over after that, you can then carry the loss forward to absorb any taxable income for up to the next 20 years. The benefit of carrying a net operating loss back 2 years is that it allows a business to receive a tax refund right now. A business may choose to only carry the loss forward 20 years. This is helpful if there were losses in prior tax years. One of the biggest surprises to self-employed individuals is that they have to pay both the employer and employee side of FICA taxes. These are referred to as self-employment taxes. This slide shows the 2015 self-employment tax rates. These taxes are calculated on Form SE and included as a tax on line 57 of Form 1040. The good news is that one half of these taxes can be deducted on line 27 on Form 1040 as a deduction for AGI. Please remember that this video only highlighted some of the key points in Chapter 3. Make sure that you read the chapter in its entirety before attempting the Chapter 3 quiz. Happy reading!